Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome everyone to this Peak Prosperity Podcast. I am your host, Chris Martenson, and it is July 18th, 2018. Today, we're going to talk about precious metals, silver specifically, which is one of my preferred investments. Full disclosure, I own a bunch of it. Now, that makes me a little bit nuts, right? Silver's been going down for basically 7, going on 8 years now. It's gone nowhere in the last year. The last month has been painful. So why silver? Well, our guest today is Ted Butler, who thinks it's going to be going up, and he's got some very good reasons. I want you to be able to hear what those are. I think he's one of the people most well-suited and qualified to be talking about what's happening in silver and in COMEX. He follows all of this space very, very closely. And COMEX, of course, is the place where metals purchases and transactions are conducted. So that's something we have to be aware of. And there's shenanigans going on in there, of course, courtesy of the banks, the bankers, and all those other participants. But really interesting story developing there, specifically around everybody's best friend, JP Morgan. So we're going to hear more on that in just a second. So Ted Butler runs his own site, Butler Research, and he'll tell you more about that in a minute. Ted's been analyzing silver for a long time, and I'm pleased to have him back on the program today. Welcome, Ted. It's great to have you back.
Thank you very much, Chris, for that very kind welcome.
Oh, you're most welcome. So, Ted, I got to start with the price of silver. Back to around $15.50 today, right where it was last July. It's gone nowhere this past year, obviously, and every time it's tried to go somewhere recently, it seems to get clubbed back down. How do you explain that price action?
Well, it's kind of simple. It's you mentioned the name in the intro. It's J.P. Morgan. Specifically, every time we've had a rally in the last year, in the last 10 years for that matter, ever since J.P. Morgan took over the investment bank Bear Stearns, J.P. Morgan has added aggressively to its paper short positions on the COMEX as speculators, technical funds, and what have you come in to chase rallies higher. J.P. Morgan has always been the seller of last resort, and they sell enough, whatever it is, whatever's required to satisfy all buying, and ultimately, after that buying is satisfied, the prices roll over, come back down, and this is the wash, rinse, repeat cycle that many people are tuning into and waking up to. But that's the answer is simply J.P. Morgan adding short positions has stopped every rally in silver and gold, for that matter, over the last 10 years. However, I think there might be something going on that it may not occur again.
Okay, well, I want to get to that in just a second, but let's help people understand what really is going on here. So let me just illustrate one thing that you're talking about. I'm looking here at June 2018. I'm looking at a chart here. Silver climbed pretty carefully over the first 9 trading days of June, did a pretty nice rise, went from 1645 roughly to about 1725. So 9 trading days, it's climbing up, and then on the 10th trading day, it's all gone, got smashed away in one day. Huge volume comes in. So to me, that kind of defines silver's typical trading pattern of late over this past 10 years, but certainly over this past year. And when it goes down like that, it positively gets smashed. Tons of volume comes in. How much is JP Morgan part of that story when we see those that crush come?
Well, J.P. Morgan is not part of the story at all once the crush comes, once the price retreats and comes back down. But if you go back and look at commitment of traders data from the CFTC, the federal regulator, you'll see that on that rally that you just referenced from in the beginning of June from 1650, whatever it was, to 1630 to 1725, CFTC data, you have to look at the concentration portion of the data, will show you that JP Morgan added 20,000 additional short contracts to 20,000 they already had at the bottom in June on that rally. So they had a short position. They added 100 million ounces of paper shorts, increasing their position to $200 million at the 1725 mark, the number that you quoted. And on the subsequent decline, that's when they start to buy back these short positions. So this is very clever. It's not that easy to see, and you have to be looking for it. But J.P. Morgan never sells on the way down. They only sell and add short positions on the way up. So the manipulation, in essence, takes place on the rally. And when J.P. Morgan adds short positions, once they're done selling and the buyers are done buying, the price stops going up and people turn to sell, that's when J.P. Morgan rings the cash register and buys back all the shorts that they've added at lower prices than where they sold, meaning they always make a profit. I don't know if you know this, Chris. J.P. Morgan has never taken a loss in 10 years when adding short positions in silver like I just described. They've only made profits, varying degrees, but never a loss. So this is the essence of the manipulation. You look no further than J.P. Morgan.
Hey, if you're never taking losses, you're not trading, because that means there's no risk in whatever it is you're up to. So clearly they have market control. Now, I'm no expert in this, but I remember reading somewhere, Ted, correct me if I'm wrong, that no one entity is allowed to hold more than 5,000 contracts in silver at any one point in time. But you just mentioned JP Morgan adding 20,000 across a 9-day span. That doesn't, how do I make sense of that?
Well, you make sense of it because there is no, there should be a position limit, and there's talk about position limit, and there's even statements on the books talking about accountability limits. But this is like a 10 mile an hour speed limit, posted speed limit on the Autobahn. Okay, yeah. Nobody pays attention to it. So, ask the CFTC how are they allowed to sell, add 20,000 contracts, the equivalent of 100 million ounces. And certainly, if I'm wrong, anybody can come back, J.P. Morgan, the regulators, and say, no, they never did this. Butler's full of hooey. That's not happening. This is what they're doing.
Well, 100 million ounces, just to put that in context, I think it was about 850 million ounces of total mine supply in 2017. Last year I got figures for, obviously, full year. And so that's 100 million out of 800 million. That's on a percentage basis, that's an extraordinary amount. I'm not aware of any other commodity where one entity in a few days' time could basically short out the equivalent of 15% of total world output.
That's a good observation. You're 100% correct. That's why silver, COMEX silver, stands out like a sore thumb, head and shoulders above any other commodity. That's what makes it the most manipulated. But I can't get more specific than this. It is J.P. Morgan. Those are the amounts that they sold in June. I can go back over the last 10 years and show you how many contracts they added on silver rallies and subsequently bought back. It's all from source documentation from the CFTC, the regulator that's supposed to not allow this in a million years.
Yeah, right. Well, good luck with that. So let's turn now to the other side of the JP Morgan story, because I was reading some articles of yours recently where, and certainly I've been hearing a lot about JP Morgan and their silver hoard. I didn't really know about the dimensions of it till I read your work. Walk us through that. So while JP Morgan's busy playing its paper games, shorting, they're also accumulating not just a big silver hoard, but maybe a historically unmatched silver hoard.
Absolutely. In fact, let me go to the beginning. back when J.P. Morgan took over Bear Stearns and got a green light of some type from the government to continue to manipulate the silver market, as Bear Stearns had been doing up until that time, March of 2008, J.P. Morgan stepped right in on the short side and did this wash and repeat, add short positions on every rally and buy them back on when the prices decline, making a profit every time. But they got almost stuck, okay? And in early 2011, when silver ran up to near $50 an ounce, J.P. Morgan was short at the time. They were wise enough not to add to short positions on that big rally, and that's probably what allowed the market to go up, among other things. But they were given the fear of God, okay, on that rally, because they were short. And when the prices went up, I think it occurred to them that this position that they're in, okay, was no good, and they needed to do something. What they decided, and it was a genius, albeit criminal solution, they decided that they couldn't buy back their paper short positions on higher prices, because that would just cause the price of silver to go to 200, 300, pick a number to the upside. They were the ones that were keeping a cap on price. So what they decided instead, in order to cover their short position and take themselves out of harm's way, they thought of this genius solution of, we'll use our ongoing ability to manipulate and depress the price of silver, cap every silver rally, but instead of just buying back the short positions at big profits when it came down, we'll use the opportunity to buy physical silver in such quantities that eventually we'll be able to offset completely our basic short position on silver. J.P. Morgan has always been short COMEX silver and really hasn't been able to get out of the position completely. It can't do it by buying back paper short positions. The only way you can do it, it decided, was to buy physical positions. And within a year or two from the peak of silver in 2011, when it came right back down to like $30 and less, okay, per ounce, J.P. Morgan had bought back about 100 to 200 million ounces of physical silver. People stopped buying silver on the way and started selling it when it started to come down. Typical investor behavior. That's just the way things are. And J.P. Morgan used that opportunity to buy 100 to 200 million ounces within the first year or two of the price peak in 2011 to basically satisfy their paper short position. However, they realized along the way how easy it was to keep accumulating physical silver, so they said, now that we've got our short position covered, why quit? Why not keep on buying physical silver, keep the manipulation game going, we'll continue to sell short, cap prices like they just did in June, and we'll use the opportunity to buy more and more silver. And they did that over to this day. They're still doing it, and they've picked up, in my estimation, okay, at least, I think it's up to 750 million ounces of physical silver right now. That's just so I'm not stuttering here, that's 750 million ounces. I think 150 of it, 144 million of it, is in their own COMEX warehouse, which they started and opened on the same day they made the decision to accumulate physical silver back in April of 2011. But 600 million ounces is held out of sight, mostly in London. And they've gotten this silver from a variety of ways, but the main thing is they got it on the way down in price, very much unlike the way that the Hunt brothers accumulated their physical silver on the way up in price, or even Warren Buffett when he bought close to 130 million ounces of physical silver back in 1997. So J.P. Morgan has got every aspect of this market covered. They are the dominator. They're the dominator of this market, and they put it to good use. In addition to the silver, the 750 million ounces of silver that they've accumulated, they've also picked up like 20 million ounces of physical gold. And that's even bigger in terms of dollars and cents because gold is a much higher price than silver. But these guys have just loaded the boat with physical metal, all while being short on the paper market, controlling the price. It is the perfect crime times 1,000.
Well, I'm just struggling to understand the exact mechanisms of this. So I know that if you are short something, you possibly have the prospect of having to deliver that metal. And if you're long the metal in the futures contract, you have the right, depending on your futures account. But if you have a delivery account, you could get delivery. So how is it that they manage to both short and get the metal? I'm stuck on the mechanism here. How does that work for them?
Well, I mean, they're two different. You have a paper market, the COMEX, which sets and determines the price. The futures market has come to set the price on every commodity, okay? Copper, gold, crude oil. You pick a commodity, and there is basically some futures contract, paper futures contract angle in the price discovery process. So if you can set the price, okay, on the paper market, you can turn around, and because everybody in the world is a basic price taker, not a price maker, all the producers of silver, all the consumers of silver, all the investors in silver are price takers. Whatever the COMEX sets the price at, okay, is the price that everybody goes by and does their business. So if you can control the paper market, the price of the paper market, which J.P. Morgan clearly can do, has and is doing, you can use that price that you're setting to take on offsetting transactions, physical transactions, not paper transactions, in markets away from the COMEX. So you use the paper to control the price, but you do your real buying in the physical market, which is dependent on the paper market for pricing. It's crazy. I mean, it's like it's upside down. It's the tail wagging the dog. It's always been the case that the futures market, okay, is basically setting the price. It's getting more egregious and more blatant every day because there is no other explanation for why silver and other commodities would be priced the way they are. You'll drive yourself insane if you're trying to come up with legitimate explanations, supply, demand, fundamental explanations for why silver is priced where it is, why silver has been priced where it has been for the last 10 years. If you're not looking at the paper COMEX manipulation, for lack of a better word, you're lost. It's like there is no plausible explanation. But once you got that price control via the futures market, the ability to sell 100 million ounces of paper silver anytime you want, okay, you can use that to your benefit. And where J.P. Morgan has used it, and they're the only ones from what I can see, they've turned around and used that price control to their benefit by buying in other markets, okay, physical silver.
Yeah, and this is, again, to broaden it out, this tail wagging the dog. I think this is an important conversation because it vexes me that it happens to something that I happen to be invested in, which is gold and silver. But I can only imagine the vexation that must befall the producers who are on the other end of this, whether they're farmers, whether you're a cocoa trader or, a consumer or user of a variety of things. The prices are being set by largely by the commodity trading advisors. You got these managed futures funds. There's just huge amounts of money in there, just winging around in the futures market. driving the cost, the price takers experience of whatever the commodity is we're talking about. And it's completely obvious to me that if a market exists to find a clearing price between buyers and sellers, that there are price manipulative events happening in everything from cocoa to oil to gold to silver. I think the whole market's a complete mess. I think the CFTC is completely, allowed a situation to develop that never should have been allowed to develop. And I think they just got overrun by the computers. I think they got overrun by the technology. I think they're outmatched. I think that taking Goldman Sachs, managing directors and putting them in key positions in a revolving door fashion in the regulatory body on the CFTC was a bad idea, and so on. But here we are. And it's true that these markets are no longer really expressing good, accurate pricing. But there's got to be an opportunity in that, right? Because, what I'm looking at here from a supply standpoint, at $1,550, silver is below the all-in cost of production for the average primary silver mine, which isn't that many, maybe 25% of 28%, somewhere in that zone of world silver supply comes from a primary silver mine, meaning that's its main or sole product. The rest of it's a byproduct from lead, zinc, copper, and gold mining. So if we look at that, though, the all-in cost of producing silver is much higher than the current price of silver. To me, Ted, that's always been a reliable place to sort of buy into a commodity. But that's been kind of upside down for at least 5 years now, by my guess, maybe longer.
You're 100% correct. I can't disagree with anything that you said. It just proves the point that something else is setting the price. It's not the producers, the primary producers, because they're bound by the laws of supply and demand and cost, and they're a taker. They're price takers. They're just taking whatever price the COMEX dishes out, and as you say, the traders on the COMEX have largely have been distilled down to just a relative handful of large, either managed money traders on one side and commercials and other traders taking the other side of those positions, and they're excluding everybody else. In this case, I have to say that the consumers of silver are getting a lucky break in that they are not hurt by these low prices, but that's besides the point. When this manipulation ends, then those same consumers who have been enjoying basically a free ride will be behind the eight ball, and the producers will be in much better shape. The question is, okay, when is this going to happen? When is this stranglehold of paper control on the price ever going to break? And therein I see, tremendous reasons for optimism. In fact, it's the mirror image of the pessimism that is naturally generated by these prices that do nothing but go down, okay, for no legitimately explainable reason. Well, these commercials, particularly J.P. Morgan, by virtue of its giant physical position now, is positioning itself, has positioned itself, and may be done positioning itself. We won't know that, okay, until after the fact. But the same causes that have driven prices down, okay, in a bewildering, unexplained fashion, are going to cause those prices to explode. And the linchpin, the thing that's going to cause that explosion when it occurs. I can't tell you when it's going to occur. I can tell you it will occur. And the linchpin to that is that one of these days, and I think real soon, J.P. Morgan is not going to add to their silver short positions as they have on every single rally over the last 10 years, including the one that you just referenced in June. If they don't add to short positions and cap and control the price, okay, the price of silver is going to explode. And I see that there's really getting to be very little reason for J.P. Morgan to add to short positions in the near future. They are positioned perfectly. They've been buying back as many short positions as they can, paper short positions as they can on this decline, and it's all in the CFTC, Commitment of Traders documentation, okay? And they reached a critical point where they can't really buy anymore because there's no sellers on the other side. When prices start to turn up, and all the technical funds and managed money traders that have been selling so aggressively just because prices have been going down. Well, when prices turn and these same traders start to buy simply because prices are going up, if J.P. Morgan doesn't add short positions, we will explode in price. And I think there's much better odds than ever before that they won't add, and the odds are basically centered on the 750 million physical ounces that they hold. If you put a paper to pencil and start to calculate how much J.P. Morgan will make, okay, on a significant price rally in history, just multiply 750 by $1 for every dollar that prices may go up. If silver runs $100, I don't see any problem in that. That will mean J.P. Morgan stands to make $75 billion. That's serious money, and that's the only reason that they're in this. They're not in this to control the world or to enslave us all or to save the dollar or anything like that. J.P. Morgan is in this to make a buck, and they're going to make the biggest buck ever when silver and gold take off to the upside.
Now, I know that the amount that J.P. Morgan might hold in COMEX is a matter of public record. How did you arrive at your estimate for what you think they might be holding in London? Where does that data come from?
Well, it's been coming over the last, I've been categorizing this continuously for the last 7 years, okay, or 6 years, ever since it dawned on me what J.P. Morgan was up to. Right off the top of my head, okay, 150 million. We know they have 144 million on the COMEX. We don't have to argue about that. Where do I get off saying that they own another 600 million that we can't see? I'll go down the list. First of all, they picked up 150 million ounces of silver, physical silver, by buying for 6 years running Silver Eagles from the U.S. Mint and Canadian silver maple leafs from the Royal Canadian Mint. Over that period of time, we had nothing but record-breaking sales, 40 million ounces a year or more in Silver Eagle sales for like 6 years running. I'm saying J.P. Morgan bought at least half of that, half of what the Canadian Mint, the Royal Canadian Mint produced. They took that 150 million coins, combination of Silver Eagles and Canadian maple leafs, melted down every single one of them into 1,000-ounce bars. And the reason they had to melt them down is that there's no way you can sell 150 million ounces of coins at any reasonable time or price. You had to put it into industry standard form. So that's 150 million ounces right there. They also got at least 250 million ounces from the SLV. When the SLV first broke in price, okay, in May of 2011, it broke by almost $20 an ounce, okay, over a 1-2 month period of time. Some 60 million ounces was liquidated. Physical silver was liquidated from the SLV at that time, within a 2-month period of time. J.P. Morgan picked up every ounce of that because they were responsible behind orchestrating the big price decline that we had starting on May 1st, 2011. So they got off to a real good start, picked up 60 million ounces from the SLV. The silver didn't stop to exist in the SLV. It was just liquidated and sold by investors. That was a big chunk for them, but for the next 7 years, they were able to get another 200 million ounces from the SLV. They are, of course, as I'm sure you know, the custodian, the official custodian of the SLV, meaning that they're in charge of keeping track and making sure that there's a right amount of physical in the SLV, the trust, okay, to match the shares outstanding. So this is their business. So they were able to convert shares of SLV anytime they wanted into metal, which they just put in their own warehouses that don't have to be recorded anywhere. There's another factor where they got as many as 200 million ounces from in the COMEX, the COMEX silver warehouses, starting in the same date, April of 2011. Started to experience a phenomenal and heretofore and to this day unprecedented physical turnover. Not many people are aware of this, okay, but every week some 4 to 5 million ounces of physical silver, I'm talking about silver that comes off of trucks into the COMEX, 6 COMEX warehouses, out of the 6 COMEX warehouses into trucks. There's a total movement of an average of 4 to 5 million ounces a week, physical movement in and out of these COMEX warehouses that started just at the same time, April of 2011, has persisted to this day. That's the equivalent of 2 to 250 million ounces annually that's physically being moved from trucks and warehouses in the New York City area into these COMEX and out of these COMEX warehouses. Over the last 6-7 years, it's close to 1.5 billion ounces of physical silver that's been turned over. No other commodity has ever had this type of physical turnover in warehouses. Not gold, not copper, not anything, okay? Just COMEX silver. I'm claiming that the only reason for this turnover was that J.P. Morgan could skim off a portion of this sight unseen without people knowing it. And of that 1.5 billion total movement that has taken place, which is highly documentable, J.P. Morgan has been able to skim off 200 million ounces or so that they've stuck in their warehouses elsewhere, mostly in London. So you're up to 600 million. I could probably go more than that, but the three principal sources of getting the 600 million ounces that we can't see is from the meltdown of eagles and maple leaves, from the conversions of shares to metal in the SLV, which they're the custodian of, and taking a portion of this frantic and unprecedented physical movement. Here's the thing you have to understand about this 600 million ounces that you can't see. If you could see it, we wouldn't be having this conversation. It would be common knowledge to everybody that J.P. Morgan has not 140 million ounces in the COMEX. They have 750 million ounces when you add it all together. The fact that you can't see this 600 million ounces, okay, is what makes it possible for J.P. Morgan to be doing this and nobody to be aware.
Now, I agree with you that they're just trying to make a buck. And that's their primary positioning. Now, as the so-called financial aspects of our system, get out of control, with financialization being the tail that now wags the dog, and it's got too much power, too much prominence, and courtesy of the central banks and flooding the world with liquidity and all that stuff. We can worry about the unintended consequences of that later, but the real world consequences are easy enough to see. And so what we've seen is that, despite a world economy that's growing, despite seeing that we're looking at mine output up across a lot of the base metals, silver output has dipped for 2 years running, 2016, 2017. The primary mines dipped another 9% in 2017. Obviously, they can't make money at this level, so it makes sense for their output to fall. That's sort of on the supply side. But looking at the demand side, first, can you shed any more light on the supply side? But also, what's the demand side? Tell us, if we were going to get all fundamental for a minute here.
Silver is basically a GDP-sensitive commodity, meaning whatever the economy is doing, silver's industrial and total demand fabrication needs are intertwined in the economy. If we have growing economic activity, we have growing silver demand. You don't have to, drive yourself crazy trying to get all the details and the nuances. The economy in the world has been strong for 6-7 years or so. There's no reason to believe that silver consumption would be down. We use it for every damn thing. It's the best conductor of electricity. You don't have to go any further. Everything we produce nowadays is electrical of some form. It's either electrical or electronic, which is the same damn thing. So it's impossible for us to have the economy that we have, and we can look around and see the world economy has been growing, over the last 5-10 years or so. Therefore, silver demand has to be up. The trick to this whole thing, Chris, is that unfortunately, because of the paper dominance, the COMEX paper dominance, on the price discovery process, you can take supply-demand fundamentals and throw them out the window. I used to spend all my time, 35 years ago, studying intently the supply-demand situation in silver. That's all I basically did. I've stopped doing it because it doesn't matter. It's like what matters is what these crooks in the name of J.P. Morgan are doing on the COMEX and what's going to be good for them. So we could debate the merits of silver, the silver mine production being curtailed by the price, and no reason to curtail demand because the low price would only stimulate demand. We could do that till the cows come home, but it doesn't matter. It's like it's all on the COMEX, and it's all on when J.P. Morgan decides to let this baby go.
And of course, that's unknowable at this point in time because obviously they've carried this on for quite a while, and I don't detect anything currently that would make them sort of shift this. But given the amount of money that they stand to make off of this, and the fact that they've done it while cornering the market in a way that the Hunt brothers were punished for, and anybody else would be punished for it. I don't know if you followed this, but Matt Taibbi just wrote about it in Rolling Stone, talking about how all the big banks got sort of nailed manipulating LIBOR, the London Interbank Offer Rate, but that was bad enough. But then the ISDN crew, also run by big banks, they were caught manipulating the swap figures so that everybody had an interest rate swap, which is a huge market. Anyway, they got sued. The federal judge just threw it out a couple weeks ago, said, you know what? We agree with the bank's argument. The bank's argument was, look, we're crooks. You should have known we're crooks. I'm paraphrasing. But this was their legal argument was, y'all knew we were going to fudge those numbers. And the judge said, you're right. Everybody should have known that. So we now have institutionalized and structural malfeasance. It's just there's no consequence for these people. So in terms of trying to figure out when they have to, when they might shift this, I think they'll do it on their own terms and when it makes the most sense for them and not a minute sooner, because there won't be any legal consequences and there won't be any political consequences as things currently stand.
I couldn't agree more. It's going to be when they decide it. So instead of, even they're not going to tell us, so we're going to have to try and, if there's any kind of inkling as to what they may be up to, I think the only way, based on what you just said, again, which I agree completely, is when it would seem to be most opportune for J.P. Morgan to let the gold market go, to the upside. And there, I'm keeping it simple. Since they own more, their net position, their physical long position minus their paper short position, they have never held a larger net long position in either silver or gold than they do as we speak, okay? And to me, that would seem to suggest that the time is much closer because JP Morgan stands to make more the bigger their position, since they have the biggest net long position they've ever had as a result of buying back these recent short positions added on the COMEX, okay, on this price decline. I would say that tells me on a logical basis, completely criminal and manipulative, no doubt. On a logical basis, that's real reason for optimism that the move up it might be a lot sooner than you expect. If they do it again, look, if they add to short positions, we get another mediocre, piddling rally of $1, $2, or even $3 in silver, and JP Morgan comes right back to the well and starts to add short positions like crazy, like they always have before, then guess what? That ain't the time. It isn't going to. They're going to be adding shorts aggressively. The odds of it being the big move up are rapidly diminished. But if they don't add the short positions, okay, it'll be simultaneous. We'll see it in price. We'll see it in commitment of traders data, and we'll all sit around wondering why the heck is silver taking off like a scalded cat. Okay, there'll be only one reason. JP Morgan is not adding short positions. If the silver price struggles on the way up, as it struggled over the last 10 years on every rally, it'll be because JP Morgan is adding short positions. I can't say what they're going to do. I can say there's never been a better time for them, dollars and cents wise for them, not for you, not for me, not for anybody that's invested in silver, not for any producer of silver. They don't give a damn about anybody. They care about themselves, and they're in the best position to make the most money ever if they let it go soon while they have this very low short position. Anyway, that's
not just a very low short position, but I think if I heard you right earlier, their longest net long position in gold and silver.
Well, that's because of the giant physical position.
Because of the giant physical position, yeah.
For 7 years without interruption, and now that the paper short position has been reduced, the net long position that they have has never been larger than us having this conversation.
Right. Well, when you and I were growing up, the phrase was "Don't fight the Fed." Now it's "Don't fight the criminals." So just keep track of them. You got to see what they're up to. And I think your analysis is spot on. They don't give a damn about anybody. They're there to make some money. It's all about the money. It's money worship, and that's what it's all about. And how many people get hurt, how many miners go out of business, what happens to the environment, none of that matters. So here they are. They've been playing their game for a long time. I just think that's really interesting analysis, and I'm going to be following it closely. And I have to put a plug in right here. Ted, I'm going to be offering with David Stockman is coming to a seminar that we're holding. It's a summit. We're going to go through data like this. We're going to cover all 3 E's: economy, energy, environment, lots of data. That's Saturday, September 19th, and you can find more about that at peakprosperity.com/NYC. And Ted, why don't you tell us about your own site and service now?
Well, anybody that's interested in digging into this type of analysis, I put out 2 fairly lengthy reports weekly, and you can get the information. You can do it on a month-by-month basis. It's not expensive. www.butlerresearch.com.
All right. Well, Ted, thank you so much for your time today and for this wonderful podcast.
Thank you. Have a good day, Chris.